Afternoon, everybody, and thank you for assisting to this webinar presented by SSQ Insurance. My name is Matthew Roy, Investment Fund Analyst at SSQ. We're pleased to welcome today Mathieu Tanguay, President and Senior Partner, and Scott Collins, Founding Partner and Portfolio Manager at Triasima. They're here with us to talk about their unique managing methodology called Three Pillars Approach and their diversified Canadian equity strategy, which is included in our new Smart Beta Plus portfolios. Please note that if there is enough time at the end, it'll be our pleasure to answer one or two questions that you can ask via the WebEx interface. Communicate with your SSQ Insurance representative for all other questions. So without further ado, Mathieu, the floor is yours.
Thank you, Mathieu. Good afternoon, everyone. Thank you for attending. So I'll start by introducing the company, giving you a quick overview of our history, and then my colleague Scott Collins will tell you a bit about our unique methodology, macro outlook, and current positioning. So if you would go to page 2, so the Triasima journey started back in 1998. The firm was founded by 3 individuals. Scott Collins was with me today, as well as André Chabot and Redouane Kiridine. All 3 of them are still with the firm today. If you made a calculation, we celebrated our 20th year last year, and here we are today, 21 years later, and the firm is still independent and employee-owned. So we have 30 employees, 9 of which are shareholders of the firm. We're known for a unique approach, which is called the three-pillar approach. We apply this unique methodology to any strategy we manage, but obviously we adapt it from one strategy to another. Scott will take a few minutes later today to explain how that methodology works. In terms of asset under management, we currently manage $4.4 billion. So we're considered a boutique. And from our point of view, we kind of bring 4.4 is kind of the best of both worlds. On one hand, we're still small enough to be nimble, especially when one plays in the Canadian equity market, so we're quite nimble. But at the same time, we're large enough to have invested in our firm. So over the last few years, we've invested first in our people, i.e. we now have 30 employees, but we also invested in our technology. And on that front, we can compete with any of the larger firms, whether it's from a risk management, portfolio management, or compliance system. At the bottom left, you can see the types of clients that we have. So 93% of our AUM is institutional-like. So we have large defined benefit pension plan, which represents 42% of our AUM, but also 51% of our AUM is sub-advisory relationships like the one with SSQ. So these are primarily financial institutions and insurance companies. On the right side, you can see that our expertise lies in Canadian equity. We've been managing equities for 20 years, whether it's US, European, emerging markets, and Canada. But in the institutional world, we're known primarily for Canadian equity, which represents 83% of our AUM. Finally, we're a signatory of the UN Principles for Responsible Investment. In other words, we incorporate environmental, social, and governance factors into our process, and it's been the case forever. So it's not something new. On the next slide, you can see our org chart. So on page 3. So the way we're structured, management committee is made of the 3 founders, so André, Scott, Redouane, as well as myself. And you can see here the 30 employees. On the next slide, we can focus on the portfolio management team. So you can see here we have the 3 founders, again, André, Scott, Redouane, but also Edward Ansac, who joined us back in 2012. Edward is managed Canadian equity before for Caisse de dépôt and the Rio Tinto pension plan, and joined us 7 years ago. And we also have Nick Aratonian, who was an analyst on Canadian equity for Optimum prior to joining Triasima. Over the last few years, we've added resources, so we've added analysts. So you can see we have 4 fairly young analysts. Had you seen that picture or that page 5 years ago, there were only 6 individuals. So over the years, as our AUM has grown, we've added analysts to the benefit of all of our clients. So what makes us very optimistic about the future is that, and you'll see our track record later, we have a fairly long track record. It's quite strong, but today it's the exact same key individuals, i.e. the three founders. It's the same unique methodology, i.e. the three-pillar approach, but all this supported by much more resources than 5, 10, or 15 years ago, i.e. more employees, more analysts, but also much better technology. So we're quite optimistic about our future. So this is us in a nutshell, and I'll now hand it over to Scott Collins, who's one of the founders, but also portfolio manager, to tell you a bit about our investment philosophy and methodology.
So hello to everyone out there. Just to say, I'm running a bit of a cold, so I'm going to obviously be able to get through this, but I might hear a little raspiness in my voice. I might cough every once in a while, but not to worry, I'm fine, and we'll get through this. So I'm going to start with philosophy on page 5, and then we're going to talk about the portfolio management process and bring it all together by looking at some of the style outputs of the portfolio and the portfolio itself. So starting with philosophy on slide 5, the point is traditional portfolio management involves a lot of art, human emotion, and intuition, and really our goal is to bring a degree of science to the process. And in order to do that, one really needs to be systematic and rigorous. And this is really true for any group out there that wants to achieve strong, repeatable results over any length of time. Additionally, one has to use well-defined inputs in order to yield effective analysis and decision-making. And at Triasima, we have very well-defined inputs with regards to fundamental, quantitative, and trend. And these are components of our investment methodology that I'm going to talk to you in just a minute, but they're all very well-defined. Strong cell discipline, absolutely required. We believe that it's important that we have a mechanism that will identify names which are having difficulties or names with higher opportunity costs. So we believe that the sell decision is as important as the buy decision. Sometimes differentiates us from other portfolio managers. And I'm going to show you how we look at these cells when we get into the investment methodology. And then the final point I would talk to you on this page is that we build portfolios with a superior combination of value and growth. Difficult to do in a portfolio of just a few names, but in a portfolio of kind of 30 to 40 names, this is possible, and by structuring portfolios this way, we can achieve greater stability and consistency of results. And that's because your value characteristics are going to help you in certain market regimes, and then the growth will help you in others. However, having said that, and even though we build portfolios which are value and growth simultaneously, and it's going to shift one way or another over time, it's important for you to understand that we are not value managers. So if you do a style analysis, or if you look at the holdings in the portfolio, you're not going to see a lot of deep value in there. What you're going to see is that we build portfolios which are typically as cheap as the market. Quite often we can be cheaper, but we always tend to have a lot more growth. Okay, so that's an important point to keep in mind whenever you're looking at the Canadian diversified mandate. Okay, so that's a little bit on philosophy. So let's talk about the portfolio management process next, and this is on slide 6. So the portfolio management process is made up of 2 distinct but equally important parts. The first part is described on the top part of this slide, and this is the investment methodology. So this is the tool that we're using to assess how attractive a name is, and it's where we use our 3-pillar approach. So for this step, it's always the full portfolio management team or 10 individuals that contribute to the scoring of the individual securities. Second parts of the portfolio management process is described by the bottom part of this slide, and that's portfolio construction. So this is where we have rules and criteria with regards to how we build the portfolio and then how we maintain that portfolio in order to control and mitigate risk. So for this step, it's always 2 portfolio managers that are responsible for monitoring the portfolio and then implementing those decisions over time. So let's talk about the first part to the portfolio management process first. The investment methodology. So that's the top part of this slide. So the investment methodology is how we're buying and selling securities in the mandate. And really there's 3 analytical methods one can use to analyze market securities and manage money. That's fundamental, quantitative, and trend. And at Triasima, we formally incorporate all 3 of them in an integrated manner. So again, the top part of this slide is a visual description of the investment methodology. And as you can see, those three analytical methods, the fundamental, the quantitative, and the trend, they're segregated into their own silos, which we call a pillar. And on this page, those pillars are represented by those colored triangles, so the purple, the green, and the blue. So each one of those pillars is independent with its own set of criteria, and each one is essentially going to derive its own conclusion or its own score. So if you look in each one of those pillars or the triangles, you can see that the best score a pillar can be is +2, and the worst score is -2. That means if you add those three pillars together, the best total score a security can be is +6, and the worst total score a security can be is -6. So if I just direct you to the scoring grid underneath those three pillars or the colored triangles, where it runs from a -6 in the red to a +6 in the green, we have a strong preference of buying securities with a total score of +2 or better. So in that green zone. And then as those scores deteriorate and become negative or move in kind of the orange and red zones, they become sell candidates. Okay, so that's a very high level review of how the investment methodology works. It's obviously far more comprehensive than this. And so what I thought I would do is just kind of run you through each one of those pillars, just describe to you how they work, and then we're going to move on to portfolio construction and the output. So just before I get into each one of the pillars, the first thing that is important for you to understand is that the pillars on the right-hand side, so the quant and the trend, so it's in the green and the blue, those two pillars add a lot of value to the investment process, and that's because they have very little emotions associated with them. They're highly automated. So it keeps us very disciplined about what can go into the mandate and when something has to be sold. So let's talk about the fundamental pillar first. So that's in the purple. So the fundamental pillar, it's the classical analysis most portfolio managers are going to employ. It's really understanding a company's situation. It's building out a scenario along with a model. And we do fundamental analysis just like any one of these other groups. We meet with hundreds of companies every year, and really this is where we're spending almost all of our time. And that's because these pillars have very little emotions associated with them. Sorry, I see the slide. We moved to slide. Okay, so the fundamental pillar is on the right hand of this slide. It's in the purple here. Important thing you need to understand about our fundamental pillar is that we're quite top-down oriented. So that means that we look at the global macroeconomic situation to see how that filters into Canada, the sectors, the industries, and then finally the companies themselves. It doesn't mean we don't do the bottom-up work. We meet with a lot of companies and we work that back up into the economy, but we do a lot of top-down work. So that means any company that we have a fundamental score on, there's going to be a top-down reflection built into that score. Okay, so that's a little bit on the fundamental pillar. The quantitative pillar, so that's in the green at the bottom of slide 7. So here we're using computers to screen and rank securities on a combination of variables that we've determined to be value enhancing. So really this is a multi-factor model. We're screening for such things as earnings growth, profitability, analyst expectations, margin improvement, things of that nature. So names near the top of the screen will tend to outperform over time. So we always want to be building portfolios with names from the top of the screen and selling names at the bottom of the screen. Okay, and that's a computerized process. We simply push the button, the system's going to produce a result. So there's no emotions associated with that. And then the final pillar, the trend pillar, it's in the light blue on the left-hand side. So here we're using tools from the world of technical analysis. It's actually not technical analysis, it's trend analysis. We're simply trying to gauge the basic trend of a security. And the reason we do this is because there's a lot of sentiment and momentum in a trend. And trends typically last longer than people think. So a stock which is trending up has higher probability moving up, and vice versa if it's moving down. So we got a couple of examples in the back, but if you guys just can imagine a security which is trending up in a nice gradual fashion, if you didn't know anything about that name, you would know just by looking at the chart that something good is happening to that security. That security is being rewarded for something to do with its underlying business, and value is being added to the share price. And that's obviously something that we like to see with any name that we own, because names have to move up in order to outperform, or any name we're about to buy, because situations like that are likely to continue for some period of time. If you can imagine the opposite of that, a name which is in a deep downtrend, and if you can imagine like SNC-Lavalin, That chart is a good example because it's in a deep downtrend and it keeps gapping down with a lot of volatility. If you didn't know anything about SNC-Lavalin, just by looking at that chart, you know something bad is going on there. That stock is being penalized for something to do with its underlying business, and value is being stripped away from the share price. So, stocks which are deep downtrends are not attractive buy candidates for us. Matter of fact, it is a big, big red flag. Okay, so if we have a name that actually is going to starts in a deep downtrend and it continues that deep downtrend, we're actually going to start to sell that name, and that piece of work will keep us away from value traps. Okay, so about each one of the pillars. Each one's independent with its own set of criteria, and each one derives its own score. We add up the scores. If the score is at a certain level or improving, the name is considered for purchase. If it's below a certain level or it's deteriorating, the name is considered for sale.
Maybe a few key takeaways here. First, as Scott mentioned, if you notice the arrows in the middle, it's very important to highlight the fact that each pillar is independent and there's no predefined order. So in other words, I mean, Triasima didn't invent anything. Like fundamental, quantitative, and trend analysis existed before Triasima was founded. But what's unique about us is the way we use the three pillars. Other managers might use a quantitative screen, but typically they'll start with the screen to reduce the investable universe from maybe 700 Canadian names to 100, and they will run fundamental analysis on those 100 securities, and then they might use technical analysis to time their trades for those names that they decided to buy. Problem with that is that if you start with a quant screen, you need to be pretty confident that your quant screen is good and it's working. And the problem is most quant screens, including Triasima's quant screen, most quant screens do not always work. There are periods where quantitative models work well. There are other periods where they don't work well. If you're in one of those periods where it doesn't work well and you're using a quant screen to start your process, it means that you're running fundamental analysis on a weak sample. In our case, the beauty of this approach is that trade ideas or investment ideas can come from any of the three pillars. So yes, it can be a name that ranks well on our quant screen, and then we'll apply fundamental and trend analysis to complement or to complete our analysis. But it could also be a name, that a company that we meet for the first time, get to know a company, like the company, so it has a strong fundamental score, and then we apply quantitative and trend. Or it could simply be a company that which stock's price keeps going up. So if the price keeps going up, it means that the trend score will be strong, so we'll apply the other two. So trade ideas can come from any of the three pillars, and a good example of that is a name called Shopify, which many of you might know. But Shopify, we bought it like 2 years ago, and when we bought it, it was -2 quantitative. So had we been using a quant screen, Shopify would not have made it to the next step. So in this case, though, because we had met the company, loved what the company had to offer, both from a top-down, i.e. more internet shopping, and a bottom-up, i.e. strong management, strong competitive advantage, and so on. So it has a strong fundamental score. The name was trending up, so it had a strong trend name. So the total score, despite the weak quantitative figure, the total score was still strong enough for the name to be added to the portfolio. So this is a good example of how the three-pillar model works. Ideas can come from any of the pillars. On a final note on this page, because of the pillars and those factors that we tend to favor, when you think about Triasima, typically what you'll see is a lot of growth. Despite our value is comparable to the benchmark, but we have a lot of growth, a lot of momentum, so positive bias to the momentum factor, and a quality bias as well. And you'll see that when we talk about performance, but because of our quality bias, we tend to outperform more in down markets versus up markets. So growth, momentum, and quality are the three factors that are, I would say, dominant in our portfolios.
Okay, so we spent a few minutes on the investment methodology. So that's really the first part to the portfolio management process. The second part is on slide 8, and this is portfolio construction. So this is where we have those rules and criteria with regards to how we're building that portfolio in order to control and mitigate risk. And really the aim is to build a portfolio to outperform the markets with a lower level of risk on a number of different metrics. So on this page, we have all our risk mitigating actions kind of categorized into 4 key areas. Now, got a lot of rules, so I'm not going to go through all of them with you, but I'm going to go through some of them so you just get a sense, a flavor for how it works. Starting with diversification. So maybe we'll just talk a little bit about the holding. So the mandate is a Canadian diversified mandate, so it's a flexible mandate, invest in the full market cap spectrum from large caps right down to small caps. However, the portfolio can hold up to 15% of the mandate in smaller cap names. On top of that, the mandate can hold up to 10% of the mandate outside of Canada. And we do that for a few reasons. One is that it allows for a little bit more diversification from an asset class perspective. So you're going to get into various areas of the world, plus you're going to get a little bit of currency diversification. On top of that, the Canadian market in some ways is not so deep in certain industries. And by being able to go outside of Canada, we can get exposure to some industries that we typically don't have. So for example, in Canada, technology is kind of like 4 or 5% of the market, whereas globally it's kind of like 20%. So there's a lot of great growthy ideas that you can partake in. Another example might be home builders in the States. We don't have a lot of that in Canada, or healthcare. We don't have that many healthcare names. So just a little bit of an example of how we can move out of Canada just to get a little bit more exposure to more growth and more dynamic industries. Also, if we have a look in diversification, so for example, sectors, so we have minimum maximum sector weights, which are based on the importance of the sector in the benchmark index. We do have a sliding scale. It's in the box. But the idea here is that smaller sectors, we can overweight, underweight by 10%, and that slides up to 15% for the larger sectors. And maybe just one last one before we move on to the mandate itself. If we look at like time, so it's the third point in the sort of first box. So this is time diversifications, how we move in and out of positions. We tend to not go in guns a-blazing with a high conviction purchase. We're typically going to start with a smaller or equal weight size, kind of 1.5%. We're going to do that first purchase, allow some time to go by, then we reassess the name from a 3-pillar perspective, see if the name is working out. If it is, we can move forward with a second transaction, and then sometimes even a third, up to a maximum weighting of 3.5%. Conversely, if the name is deteriorating, we sell it in increments as well. So what we're doing is we build up a position gradually, and then we deconstruct it gradually as well. It's time diversification. Okay, so we got a bunch of other rules. I'm not going to go through any more for the time being, unless somebody has a specific question on them, or if we are looking at the portfolio, we hit one of the rules. So why don't we look at the output, and we're going to look at slide 9 first. So this is the quantitative parameters of the portfolio. It demonstrates how we build portfolios which are value and growth simultaneously. What we're showing you here is 6 out of 40 variables, the quantitative variables that we monitor over time. It's also 5 of the 11 variables that we screen for in our screen. So if we have a look at some of these variables with just a little bit more granularity, like value, so there's a PE ratio. You can see that our mandate, which is in the light blue, has a PE of 16.5 versus the benchmark, which is 15.8. So roughly in line with the benchmarks at the end of August. So that's kind of what we expect to see. Quite often we can be a little bit lower. We're just in line right now. But if we look at the growth metrics, we have a lot more growth. So earnings momentum, so that's earnings growth. We can see we're at 3.5 versus the benchmark, which is 0.7. So that's a material difference. And then cash flow momentum, which is cash flow growth, we're at 2.6 versus 0.9. So again, a lot more cash flow growth. If we look at profitability, you can see, and this is the bottom left-hand chart, we can see that the Triasima mandate has an ROE of 16% versus the benchmark, which is 13.4. So names are more profitable, fine. So that's something we like to see. And then the last 2 metrics on the bottom right-hand side, or the middle on the right side, these are expectations. These are very powerful metrics in the quant screen. We can see the estimate revisions, the one in the bottom middle. we can see that the names in the portfolio are the mandate has 0, so the names are not being revised up or down, where the market, those names' earnings are being revised down by 2.2%. So that's a big difference. Okay, so this is what the portfolio looks like from a quantitative perspective. This is what we want to see whenever we want to look at it, sort of as cheap or cheaper portfolio with more growth, more profitability, better expectations. And it's partially how we control risk as well. So if we move to slide 10, we'll look at the ultimate output, which is our 3-pillar scoring page of the portfolio. So this is the Canadian Diversified Mandate at the end of August. So the names are broken into 2 columns and grouped by sectors like you would expect to see. So energy, materials, industrials, running right down to real estate. So what you have on this page is the name of the security, the symbol of the security, the equity weight, and then you have the 3-pillar scores broken out. You have the quant, the fundamental, and the trend, and the total 3-pillar score just to the right-hand side of that. Excuse me. And then we've overlaid a heat chart on top of that. The heat chart indicates whether the score has improved or deteriorated from the previous quarter. Red, the score has deteriorated. Green, the score has improved. The darker the color, the more the score has changed. And what you'll notice here is that names with higher 3-pillar scores, those are the names that we've typically have bought or we're adding to, and names with weaker 3-pillar scores are typically the names that we're reducing or selling or about to be sold. So just by looking at this page, you can get a sense of what we like, where the portfolio is being positioned, and where we're likely reducing some names. And it's very obvious when you look through it. So maybe I'll just run you through a few examples. So if we look at energy, so energy is a pretty bad sector right now. There's a lot of stuff running red, and actually a lot of that space is some from a 3-pillar score is almost uninvestable, but we're picking the best out of a bad bunch. But if we look there 3 rows down, you have Enerflex, EFX. So its quant is a -1, the fundamental is a 0, and your trend is a -2. So your overall 3-pillar score is a -3. This is a very bad score. You can see the name has a very small weight. It's 0.3, and we're in the process of selling that name if it hasn't already been sold. So that gives you an example of how we'll use it to identify names which need to be sold. If we look at some of the names which have stronger scores, for example, like if we go into materials, you're going to see the gold names all have fairly strong scores, and that's because their trends are very strong. A lot of them kind of have the best to second best score. The quants, the names have moved up in the screen because what we see is that as the gold price has been moving up, the cash flows have been improving and their valuations have been getting a little bit better, so better from a quant perspective. And then the fundamental, because we're in a low rate environment and there's some uncertainty with the economy and maybe political as well, gold is a little bit more in favor, so the fundamental is a little bit stronger too. So if we have a look at a name like Kirkland Lake Gold, so it's kind of like, I don't know, about 7 names down, ticker is KL, you can see that the overall 3-pillar score is 5.5, your quant is a 2, your fundamental is a 1.5, and your trend is a 2. So that's a very strong score, and the weight is 4.1% in the portfolio. Okay, so that's a little bit how it works. And let's maybe just have a quick look at the positioning of the portfolio. If you move to slide 12. Okay. So this is the positioning of the portfolio over the last 5 quarters. And yeah, so if we have a look at how the portfolio is positioned at the end of the quarter versus the benchmark. So I'm looking at the second to last column where it says June 2019, and you can see there's a cash level of 4.1%. So that's the cash level at quarter end. Really, we consider that to be fully invested. Anything under 5% is fine. So there's no call, or the names has not, the methodology has not brought us to some sort of an overweight in cash. But if we have a look at some of the sectors here, so energy, you can see, so that's kind of the 3rd row down. We're at 13.6% versus the benchmark at 17.1. So we have a decent underweight there, not exposed as much to energy. And if you look at some of the names we have in there, the kind of lower beta names, we're not in the higher or more risky servicers, such as the drillers and the frackers. We have a few E&Ps there, but we have a lot of pipelines and storage, so it's lower beta stuff. If we look at materials, you can see we have an underweight. We're at 8% versus 11%. But if you break that out, you would actually see that we have more gold in the market and less base metal. So again, it's more of a defensive positioning. If we have a look at some of the cyclicals, industrials, we have about a market weight. We're at 12.4% versus the benchmark at 11.4%, so it's not a big call there. Financials is an area where we're a little bit underweight, so we're at 28% versus the benchmark at 32%. So certainly, as we've seen some concerns with the economy and rates, we've become a little bit more defensive with regards to the banks. We're a little bit underweight, although I have to say we've been undoing that a little bit recently as rates have started to move back up, and as the rates have, mortgages have become a little bit more affordable. It's caused the bank's mortgage business to sort of start to grow again. And then the last point I would bring here to your attention is that in terms of income and safety, we have been increasing that over time. So that includes your consumer staples, your communication, utilities, and real estate. So if you add those four sectors, we're kind of at 22.1% versus the benchmark, which is 17.2%. So a healthy overweight in sort of these lower beta, higher yielding names. And that's because the methodology has brought us to become a little bit more defensive from that perspective.
Can you talk about how that aligns with our top-down view?
Yeah, so in terms of the top-down view, really the global macroeconomic situation has been deteriorating for some time. So when we have a look at the leading indicators, PMIs, and GDPs, it has all been softening. And then we've got the trade wars, which has been causing trade to stall out. And so, we've had this global growth slowdown, and that is only accelerating. So we saw the U.S. manufacturing PMI last week. It was a horrible number. It came out at 47.8. It was much lower than expected, and it caused the market to come off. Central banks have become more accommodative, so we see rates come down. But there's no question the slowdown seems to be continuing. And what we're seeing is that our three-pillar scores is bringing us to more defensive names as cyclicals become less and less in favor, according to our methodology.
So maybe we can finish. We have a few examples, but we can keep them for later if anyone's interested. But for the time being, maybe we should go to page 17 and talk a little bit about performance. So this is performance of the mandate. So this mandate with SSQ has been on since 2006, so roughly 13 years of track record. If you look at the top right, over the years, this mandate has generated about 8% versus 5.8% for the benchmark. So an outperformance of a little bit over 2%, so it's quite good. If you come back a little bit more to the left, you see the year-to-date performance. We're having quite a strong year this year, 19.8 versus 17.1, so 2.7 over benchmark, so very good performance. However, what I'd like you to look is at the different years. Bottom right, you can see our beta has been 0.7. So we don't always maintain a beta below 1, but historically, more often than less, our beta is in the area of 0.7, 0.8-ish. If you look at the different years, notice that typically in those years where the TSX was in negative territory, we outperformed. So 2011 is a good example. 2015 as well. Like 2015, we managed to finish over zero despite a -8%. So good capital preservation there, thanks to our lower beta / higher quality positioning. The only exception is last year. So late last year, we had a awful fourth quarter. It was quite painful. If you remember, late last year, very quickly, growthy / momentum names quickly became out of favor, and that's what we favor typically. That's those biases that we typically maintain. So we strongly underperform in the fourth quarter, but otherwise, typically in negative markets, we tend to do very well. So again, about 2% value add over the years. Good capital preservation, not always the case, but in most instances when the market's negative, it is the case. Good year so far this year. So this is our performance. In conclusion, before we open it for question on page 18, like few key takeaways. So Triasima, an independent firm, 30 employees, all based here out of Montreal. We're known for a unique approach, which is called the three-pillar approach, which Scott explained. When you think about us, typically what should come to your mind is growth at reasonable price, and momentum and quality, and with a focus in most instances on capital preservation. So we'll be ready now for questions if you have any.
Thank you, Matthew. So like you mentioned, we'll now proceed to the Q&A part of the webinar. So the first question that we received, how is Triasima poised to rebalance the portfolio in an environment trending towards negative interest rates?
Okay. So rates have been trending lower for years, and the portfolio will naturally align accordingly. In a lower rate environment where the economy slows, there's going to be a shift to income and safety, and that's a little bit what we're seeing right now. We were a little bit more cyclical in 2018, and the methodology has slowly brought us to more yield-oriented securities, so lower beta names in utilities, real estate, and consumer staples. And then, if you can imagine, as growth hits the system, the scoring and our top-down view will change and will naturally bring us back to more cyclical. So, if you can imagine, like the economy starting to get better, maybe because of lower rates, it will cause the trends of the more growth-oriented names or more cyclicals to improve, the cash flows to improve, and for top-down thinking. So then we'll see a natural move back to more growth and cyclical securities.
Your question highlights the fact that we're trend followers. So in other words, what the three-pillar methodology does is it brings the portfolio to gravitate towards those factors that are becoming in favor. So right now, as rates are going down, interest-sensitive names are becoming in favor. So the model will naturally bring the portfolio towards those names. So for the time being, we're very well positioned, and it's all we're coming back to performance. We're very predictable. In other words, whenever there's a trend in the market, we'll tend to do well. So as long as rates continue trending, either remain low or go negative, it'll be fine for us. If there's a reversal, as Scott mentioned, if it's a slow reversal, we'll do fine as well, because the market will, not the market, but the model will quickly pick up on that and will move. The worst environments for us is the sudden regime changes. So if rates were to pop, for example, that would be problematic for us. If something that's in favor suddenly goes out of favor, like late last year, that's when we'll underperform. So quick reversals are painful up or down, but as soon as we identify it and we confirm a new trend and new factors being rewarded, we'll move the portfolio towards those factors and we'll start adding value again. So again, coming back to your question, right now we're positioned for a low rate environment. As long as it stays like this, it's fine by us.
Great. Thank you, Matthew and Scott. Second question that we have, what is your forecast for the Canadian dollar versus the US dollar and the effect of the exchange rate on the stock price as the world tends to go towards US dollar de-dollarization?
Okay. So a few things in that question. Let's maybe start with the US dollar de-dollarization. And just so everybody understands, when we're talking about that, we're referring to the shift from US dollar denominated trade and associated contracts to some other currency. Our thought is that we're not necessarily trending to de-dollarization in a meaningful way. I know it's been in the press and there's been some chatter about it, but if anything, it's a very gradual process. And the reason for this is that the US dollar would need to be replaced by another currency, and there aren't really a lot of substitutes out there. So any currency that were to be replaced by the U.S. dollar, and you think about it, it has to be stable, predictable, liquid, backed by strong policy and controls. And when you consider this, there aren't many good options. You've got the euro, which is probably the closest, but it's kind of plagued with a few issues. The union's fracturing a little bit. Chinese yuan kind of comes up, but as we all know, it's kind of semi-controlled. Bitcoin, it's early stages. This is very risky. And one thing we can tell you about Bitcoin is that central governments don't like it when they can't control the money supply and monetary policy. So you almost feel like it's only a matter of time before the hammer comes down on that one. So our conclusion is that really that de-dollarization is very slow moving, and it's not really going to impact equities in a quick way, if I can say that. As for the outlook, Canadian dollar versus the U.S. dollar, we don't do a lot of forecasting here. What I can say is that it's recently moved up. It's up against the U.S. dollar, but I think it's just over 2% year to date, and that's because Canada experienced some unexpected strength in the second quarter for the most part. So we saw stronger consumption and trade numbers in the second quarter. I don't think that's going to hold up in the third quarter, but it caused the Bank of Canada to be more neutral, or certainly less dovish than central banks around the globe. A lot of central banks have been easing in one way or another. The U.S. Obviously has been more dovish recently, and that's why you have the differential there. Going forward, the Canadian dollar is going to move accordingly with the relative strength of the economy and the prevailing rates. And again, we don't do a lot of forecasting, but the thought here a little bit is the basic scenario is that things are deteriorating. We are going to see economic slowdown. We're seeing the growth slow down right now. It might end up with some sort of capitulation. So we could see a weaker economy for a little bit longer, and that might cause the Canadian dollar to be a little bit weaker going forward. But we're hopefully going to come in for a soft landing and then re-accelerate. And certainly if there is a lot of strength for Canadian commodities, that could cause the Bank of Canada to increase rates and maybe see a little bit more strength later on. So it's about as much as I can say about the Canadian dollar for the time being. But the one other thing I would say is that we do a lot of stress testing in the portfolios and scenario analysis to see how various macroeconomic and factors affect the portfolio in isolation. And one thing we do look at is how the portfolio would be affected if the U.S. dollar increases or decreases. And right now, there's no active exposure to the U.S. dollar. So even if it jumps or if it declines relative to the Canadian dollar, it's not going to be detrimental or beneficial to the portfolio.
Versus the TSX.
Versus the TSX, yes.
Okay, thank you again. We have another question from a participant. What is the minimum amount to invest in the fund, and is it eligible for an RRSP or a tax-free savings account?
Well, I mean, what I would say is that this is probably a question more for SSQ and
I would say I think a representative could get in contact with that person, and we'll.
Yeah, hopefully the minimums aren't too high, but the fund is eligible for RRSPs. I can say that much.
So thank you for your time, Matthew and Scott. So we have no more questions at this point. So this will conclude the presentation. To all of the people who listened to the webinar, please note that your accreditation certificates will be sent to you in the following weeks by our support team. So again, thank you for your participation, and come back in December for the next webinar. So thank you, everybody. Have a great day.
Thank you.
Thanks.